Hi, Norman Hallett here with your next 4-minute drill. Today, let's talk about highly volatile markets. I'm not talking about your normal breakout and pullback type markets. I'm talking about wild swings, usually based on big economic, political, or weather-related facts, where futures markets have limit days and stock market volatility indicators like the VIX are soaring. Some traders, especially those just starting out, your best course of action may be to stand aside. Volatility breeds high emotion, and if you're not used to risking your money in this environment, it may be best to watch the action and go by my favorite motto: I'd rather be out of a trade wishing I was in than in a trade wishing I was out. Okay, the hard part of trading volatile markets is keeping your risk under control. And by under control, I mean in the 2 to 3% of your account value range per trade. Now, to do this, you're going to have to adjust your trading time frame in many cases. If you usually trade 60-minute bars, you may want to move down to 10 or 15-minute bars and use the same technical indicators you always use. If you trade 10-minute bars, then 5-minute bars may be more suitable in volatile markets. By reducing your time frame, your chart formations will complete themselves more quickly, and you'll be in and out of the markets more quickly according to your trading plan. You see, in volatile markets, you generally can't be buying and holding because the whipsaw action can kill you. And I think you know what I mean by that. Now, there's another approach for those with greater risk tolerance, and you feel that volatile markets present grand opportunities to profit, and you're willing to take a greater risk because things like blow-off tops and runaway gaps may be part of the action. For you, my suggested approach would be to reduce the size of the position you're trading to half or less of your normal size and take a more macro view of the market. For you, you're going to want to look at a wider time frame bar chart, like a daily bar chart if you trade 60s or 30s, so that you can get a broader perspective of the action and look to capture more of the grand or total move. By widening your scope and lowering the size of your position, you'll be able to better withstand the volatility and the big swings that highly volatile markets always give you. Remember, the key is to keep your risk to 2 to 3% of your total equity if you're day trading, and perhaps 4 to 6% if you're going to go after the grand move that should result in a 10 to 20% reward. I recommend that if you're going for the big profits in a volatile market, that you have a few years of trading experience behind you. You'll be experiencing emotions that you've never experienced before, and if you don't have your subconscious mind in the right frame of mind, you're going to be headed for disaster. So you got to have the experience. Now, if you have been paying attention to your mental and emotional fitness, and you've been trading consistently, and you've been training your mind to be ice in the veins disciplined, then when the markets heat up, well, you're ready, so go for it. If you're new to the ways of the trading, the disciplined trader, then stand aside, because your time will come soon enough. Believe me, markets will always give you opportunities. Again, in volatile markets, look at adjusting your time frames to fit your trading style, day trader or position trader, and keep the risk under control. If you're new to trading, watch the action this time around and learn from what you're watching. Your day to get into the action will come soon enough. Okay, that's it for this edition of the 4-Minute Drill for Traders. So until next week, let's say it together: stay disciplined.